Hello and welcome to Making Sense of Financial Statements, presented on behalf of the Victorian Council of Social Services as part of the Clearinghouse Rural and Regional Training Program. My name is Michael McGann and I'm a Senior Project Manager for Matrix on board, a consultancy company that works exclusively with non-profit organisations, building capacity in financial management, management support and governance. My background is in financial services, where I've spent the past 5 years working with small to medium-sized financial planning firms to help them achieve their goals and objectives. I hold a Diploma of Financial Services and a Master's in Organisation Dynamics, and at Matrix I work with CEOs and boards of not-for-profit organisations to help them to develop their management capacity through business and strategic planning. I'd like to welcome you to these training programs, which will introduce you to financial statements, some common accounting methods, and the importance of this information for boards when they make decisions regarding the current and future capability of your organisation. Accompanying this presentation is a participant manual, which can be downloaded from this site. If you have previously attended one of the workshops that were conducted, it is important to note that the presentation has been altered in structure to accommodate the short video format. However, the content is unchanged and can be found in your participant manual. This is the fifth of our information programs designed to help people prepare, read and understand financial statements. In this session, we will look at financial ratios and how they can support the board to make informed decisions regarding the organisation's financial position. One quick way of assessing the financial health of your organisation is to apply a simple set of financial ratios which can be used at any time to check how well your organisation is performing. An example of the way financial ratios are used is where the financial analysts assess the viability of a funded service. Before we commence talking about financial ratios, I'd like to introduce some terminology which will be referred to throughout this presentation. Firstly, assets. These are the entries on a balance sheet showing all properties, both tangible and intangible, and claims against others that may be applied to cover the liabilities of a person or organisation. Assets can include cash, equipment, stock, property rights and goodwill. They refer to the entire property owned by a person or organisation, especially one that's bankrupt that can be used to settle debts. Liabilities are amounts owed by the organisation. These include grants in advance, leave provisions, PAYG and GST collected. Equity is the total assets minus total liabilities of an individual or organisation, also called members' equity, net assets, net worth or accumulated reserve. In this presentation, we will look at three ratios that can be used to determine the financial position and solvency of an organisation. These are the working capital ratio, the reserves to expenditure ratio, and cash reserves. Whilst a balance sheet gives you an indication of the organisation's financial situation at a particular point in time, it doesn't necessarily allow for tracking the financial growth or otherwise of the organisation. However, ratios, which can be calculated quarterly, provide an indicator for how well your organisation is performing financially. You'll find more information and exercises on ratios in your participant manual. The working capital ratio gives an indication of how well the organisation is placed to pay debts as they fall due. It is a measure of how much you have against how much you owe and is calculated by dividing your organisation's current assets by current liabilities. A ratio of more than 2 is good and less than 1 is not good. In the example above, the organisation's working capital ratio suggests that for every dollar that is spent, they are bringing in $1.25. The reserves to expenditure ratio gives an indication of how large a financial buffer an organisation has. The larger the buffer, the better the chance of weathering unexpected financial stress. A ratio of greater than 18% is considered good. The last ratio that we will look at is the cash reserves ratio, and this is used to measure the number of weeks an organisation could operate if all the income ceased immediately. It is calculated as cash less grants in advance divided by average weekly expenditure. Cash reserve of greater than 10 weeks is considered healthy. Boards and managers can use ratios and indicators to shape behaviour within the organisation to support sustainability and cost-effective service delivery. The Australia Council uses a financial position matrix based on ratios to determine an organisation's financial health, and a copy of this is located in the participant manual. This concludes the training sessions on making sense of financial statements. On behalf of Matrix On Board and the Victorian Council of Social Services, I'd like to thank you for joining me. We trust they've been informative and helpful, and please feel free to watch them as many times as you like and refer your staff to use them as an ongoing resource to ensure your organisation's financial well-being. If you'd like more information, please contact us on the 1800 number or email address on this page.